Good afternoon, everyone. I'm Robin Panovka from Wachtell Lipton, and I'm going to moderate this next panel. Our topic is Reimagining the Future of Real Estate and REITs in the Digital Post-COVID Era. Quite a mouthful, I know, but the focus is quite simple. It's a deep dive on the line we hear so often these days that, thanks to COVID, the future arrived early. There's no question about the acceleration of digitalization in the last year. We've all been living through remote working, increased online shopping, delivery of everything, Uberization of everything, and the increasing use of technology in every aspect of our lives. The focus of this panel is what to do about that in the real estate industry, what it all means for REITs and various forms of commercial real estate in terms of business models, operations, investment, development, redevelopment, use of prop tech, and so on. But most important, how to get ahead of these trends. We have an incredible group of speakers to cover these topics. Top CEOs and thought leaders from the private equity, office, retail, healthcare, life science, multifamily, and digital real estate sectors. We're going to start with a conversation with Ken KAPLAN, Global Co-Head of Real Estate at Blackstone, MARC ORDAN, currently CEO of MEDNAX, a healthcare service provider, and previously CEO of Quality Care Properties and Sunrise Senior Living, as well as Washington Prime and The Mills, and Lisa Palmer, President and CEO of Regency Centers. And then we're going to shift gears quickly and keep talking about the same topics with three other CEOs and thought leaders: Mark GANZI, President and CEO of Colony Capital, which has been moving aggressively into digital real estate; John Kilroy, Chairman and CEO of Kilroy Realty; and Mark PARRELL, the President and CEO of Equity Residential. So please fasten your seatbelts. We have an amazing group to talk about these topics, and I think it's going to be a fast-paced, very interesting conversation about all of the ramifications of these trends we've been talking about and witnessing this last year. Okay, so Ken, why don't we start with you? Blackstone seems to have been way ahead of the curve and shifting towards digital type investment long before COVID. Can you give us your thoughts on how that happened, the strategic thinking behind it, and given where we are in the cycle now, what types of shifts might we expect in the future from Blackstone's investment strategy?
Sure. Well, first, just say great to be here, even virtually. Hopefully next year we're back in person. No, it wasn't great to have the year off last year from the NYU conference, but it is at least great to be back and part of it. And I'd say you captured a lot in that question. I guess I'll start by just saying thank you for the compliment. We do try to stay ahead of the changes that we're seeing, as I think all of us do, right? But that is certainly a hallmark of what we try to do. It's high conviction, thematic investors. We have a large scale global real estate business, but that doesn't mean that we just sprinkle the capital around all different sectors and geographies. We're very concentrated in terms of where we invest and how we invest, both sector and geography. And a lot of those convictions and themes are centered around digitization and innovation and change, which is appropriate for the topic of this panel. And that approach has been very consistent, I'd say, over several years, well before COVID. And that approach in terms of looking into how things are changing has led to, as you just mentioned, shifts in our portfolio over time, shifts towards segments of the real estate market that are more poised for outsized growth because of the changes that we're seeing happen, changes in how we shop, changes in how we live and how we work, how we play and travel. again, pre-COVID. And, as I'm sure we'll talk about, some of that accelerated, some of that interrupted by COVID. And best is to use an example, which would be logistics. That's been our number one theme for the past decade. If you look at our portfolio back in 2010, we had very minimal logistics investments, is about 2% of our global portfolio. Today, it's nearly 40% of our portfolio. So that's quite a big change, over the past decade. And that really started from, post GFC, us finding some, good value investment opportunities in the space. We'd seen, new supply coming down and fundamentals starting to improve. But it started from some good value opportunities and homework we had done around that. And then from there, in terms of what we saw in our portfolio and in the market, it just built on, that conviction and that strength and enthusiasm for the sector. And that's continued through today. And the nice thing about our business and the nature of these themes today is they tend to be global, right? So, this logistics theme is not just a regional US theme, it is a global theme. So after getting going in this in the US, I was actually in Europe at the time when we started investing in logistics back in 2010. We said we have the same backdrop here in Europe. Our Asia team said the same thing there. And again, fast forward to today, and we've acquired over 1 billion square feet of logistics, and it's again the largest component of our portfolio. And again, getting back to digitization, a lot of that is driven by e-commerce, right? And this fundamental change in the utility and the demand for this asset class. And that was changing, well before COVID, for several years. But that certainly is something that got accelerated, and amplified, right? And depending on what report you'll read, a few years to several years of adoption that happened, over the past year. And you're not going to necessarily see that same rate of growth, this coming year, but certainly in our minds, it's something we continue to have enthusiasm for in the direction of that tailwind for the sector. And then again, as we look at, even within that space where we're most enthusiastic, it's in these last mile infill locations where you have the strongest demand and it's hardest to add supply. So to us, that's an example, and it's not the only example. Life science office is another area. We bought a company called Biomed 5 years ago that we really thought was misunderstood and undervalued by the market. And that, with the changes in medicine and innovation around that, we got really enthusiastic about, along with these companies needing to be and wanting to be in these nodes like Cambridge, Massachusetts. Content creation, we made a large investment last year in a studio portfolio with HPP out in Hollywood, and that followed an investment in some office buildings in Burbank, all around media and content creation, which is already growing again pre-COVID, and as during COVID, we all consumed a lot more content. We're creating more content right now, and so that fed into and feeds into that enthusiasm. So those are some examples, and that's where we continue to have the most enthusiasm investing. By the way, it's not all technology and digitization related, but that does drive a lot of our theme and where we're investing capital.
So couple of questions. You said 40% logistics.
Yeah.
What about the other kind of digital driven areas like cell towers, data centers? Mark GANZI was saying Colony is shifting into kind of all of those, not just the logistics part. Are you guys thinking about that, and do you have things in those areas?
Yeah, we spend time on we spend time on the data center side for sure, and we do that actually across the firm. With our tactical opportunities business, our infrastructure business as well. So we've looked at that together with them. We've made some investments in the data center space too. I think it's actually a really interesting space, and there you've also seen extremely strong demand as the consumption of data continues to grow. So that is another exciting area that's obviously heavily impacted by the digitization that we're seeing across the economy. Cell towers. We haven't really focused on cell towers for our real estate business, but that's certainly another area where you're seeing strong demand and strong growth. And other parts of Blackstone have been focused on the cell tower space.
Got it. Got it. So we'll come back to that. But Mark, let's shift to you and talk a little bit about healthcare real estate. You, as we were talking earlier, have run pretty much every kind of REIT there is, but of late you've been focused on healthcare, both as a service provider and in the real estate space. What do you see coming there in terms of prop tech, digitalization, and so on? What should we be looking out for?
Well, my past has been a combination of healthcare and retail real estate, and I think oddly you're seeing common themes. To excel and survive, you've got to adapt. The changes, not just from COVID, but from technology that enable the delivery of healthcare to shift are enormous. So when people traditionally thought you just go to a bricks and mortar place for healthcare services, that's just no longer the case. So whether it's the logistics of it, people can go to see the patients, telemedicine, the ability to be in a facility that can really flex based on demand and based on health conditions. This is sadly not going to be the last time that we face something like a pandemic where and even if it's on a local level, people now know that they have a lot more latitude with how they're going to get their healthcare needs provided. So right now I'm running a large healthcare service provider, and in our real estate, we need to maximize flexibility. As a real estate owner, I would say a good real estate owner would be very wise to realize that people don't have to come to you. So the location better be smart, not just where it is, but how it's configured. So I think that it's going to require real investment in prop tech to stay vital. Now the great news about all of this, I think it's going to make the delivery of healthcare vastly more efficient than it's been in the past. And a doctor will be able to see many more patients than they have in the past. A patient looking for an appointment will be able to get that appointment right away, as opposed to saying, come back next Tuesday. So, you're seeing more people. It's good for business. It's good for patients, but it's going to require ramped up technology to do it.
So you say the real estate will have to get reconfigured and be smart. What do the various types of healthcare real estate look like in 5 years? Do you have some kind of a vision for what needs to happen?
Well, I think, I think a lot of it is going to be technology. I think that, and it's probably going to need to be, Ken talked about that last mile. I think that's what's really important in healthcare as well. Is how do you make it really convenient? You could understand how you could have a massive operation, 20 miles from everybody in the population center, but people are going to want more and more to say, I'm not traveling that far. I need to get my care immediately. So it's going to be a combination of local real estate and also being able with telemedicine and other areas to be able to leverage that. Now, I think if you have the right the great thing for real estate is I think if you have the right location and you can leverage it the way I described, it's going to be a vastly more productive, an analogy would be a restaurant that's solely dependent in its four walls on people coming in to eat now can make a hell of a lot more money if it's a combination of that and takeout and delivery. So I can't help but use a retail analogy.
How about the senior housing component? You used to run Sunrise. What happens in that business? What are the disruptors there?
Well, I think there too. I mean, the people coming into senior housing today are very technology enabled. So the customer is very different than they were before, which requires a lot of the senior housing stock to be much better than it was. I also think a real challenge for senior housing, given what we've learned in the pandemic, is how do you operate in an increasingly challenged environment? When germs and infections can rise up really fast. I think it's a real challenge. I confess I don't have a ready solution for that. I think it's tough. There's a lot of senior housing stock where people are very close together. Obviously, I was also an owner of nursing home real estate when we had all of Manicare's real estate. I think it's a very difficult challenge to meet.
Got it. Lisa, let's shift to you and talk a little bit about retail. I was struck in looking at your latest investor deck at one, how strong the recovery has been for Regency, but two, just how adaptable you guys have been and open to change to deal with the digitalization. I think you talk about the continued evolution of physical retailing. Can you talk a little bit about that and where you think it's heading?
Sure, but first I have to go back to what Ken and Mark both said, because they set it up perfectly for me. And I really appreciate that. They both mentioned the last mile. And Mark's exact words were, people don't have to come. And Ken mentioned just the acceleration of what was already happening. So this was already happening, and something that Regency was certainly already challenged with and faced with, and that is e-commerce was gaining market share in every category, even in restaurants, right, in terms of delivery and takeout. And we were already adapting to that. Overused phrases, right? The only constant has changed, but it's really true. And the other maybe overused phrase is that not all retail is created equally. And so what the pandemic, I think, really reinforced and validated is that last mile is really important. And people don't need to come. You can do everything you need to do from inside of your four walls. But again, I think what the pandemic actually really reinforces that, generally speaking, humans are social beings, and they want to move and they want to get out. So we, as Regency, are, strategically and intentionally have built a portfolio that is close to people's homes. And we are serving that need for the last mile as well as for placemaking and experience. And that's really important. And we are, part of our strategy is ensuring that we're also merchandising to the retailers and the service users and the restaurants that actually understand that. And also understand that to serve their customers well, they need to play in all arenas. Look at Amazon's commitment to physical bricks and mortar stores, another validation of how important it really is to be close to your customers. So with that, to more directly answer your question, we were already really well positioned to serve the customers. Over 60% of our product is essential, so stayed open to serve the customers that were still essentially confined to their homes and their neighborhoods. And again, a lot of what happened was already happening. It accelerated, and appreciate you recognizing, curbside pickup, again, really accelerated, and that is here to stay. And we are continuing to work with our retailers and other service providers how can we do that better? How can we leverage technology to do it better? The same thing with using open spaces, so more creative with outdoor dining, with outdoor exercise. And again, I don't think we've been speaking a long time about e-commerce and the impact on our product, our retail. But I think it was Mark that said it. It's really the technology that has the direct impact to us. And how can we leverage technology to make us better, to make our customers' experience better, to help our retailers and to partner with them? And I think what we're beginning to see is that there is more of a partnership with those retailers, with real estate owners, especially in that last mile and that close to the neighborhood. And that, again, I appreciate you recognizing what we've done, and we were well positioned, and we believe we're really well positioned to continue to benefit from what may be some more permanent changes from COVID.
That's interesting. Everyone somehow touched on the last mile. So let me ask you this, Lisa, and then maybe others can comment. Is that last mile increasingly suburban, or post-COVID is the densification trend going to resume? What kind of bets are you making about where you want to be?
Again, I think that we are very well positioned with being in the suburban infill markets. And I do believe that remote work, and whether it's hybrid or more full remote, is going to be one of those permanent changes. from COVID, and we are seeing some pattern already of micro migration. So not necessarily leaving gateway cities, but moving out perhaps, even if it's maybe a second home in the suburbs. And so I do believe that that is a permanent trend, and that we will continue to see that. And when people are going to be spending more time in their home office, again, going back to being human, social beings, that they're going to need to get out and want to get out. I do think that that benefits neighborhood community shopping centers or even medical, wellness that is closer to the home. Because again, people don't need to travel and aren't going to want to travel far. They're going to want to stay close to home.
Ken, you agree with that assessment of the trend?
Yeah, so we're still believers in cities and people wanting to be, I think as Lisa mentioned, have the social interactions. But we also are seeing strength in these suburban markets as well. And we've been very active in terms of garden apartment investing across the U.S. And we're seeing actually increasing strength and fundamentals in those suburban apartments across the U.S., particularly in markets where you're seeing stronger population growth and migration. We've been concentrating in these Southeast and Sunbelt markets, and that's been strong. But we are still believers in cities as well. And Lisa and Mark, and I said this earlier, in terms of last mile and convenience is really important. We do have some retail. It's not been one of our key themes, but we do on retail. And as Lisa said, not all retail is the same. And Lisa's a great portfolio, and it does offer that convenience. And we have a portfolio company called Shopcore that owns retail, and at Shopcore, we would say cost, convenience, and experience. You have to offer some combination, ideally all three, right? But some combination. A lot of retail doesn't offer any of that, but some does. And the types of properties that Lisa owns, the types of properties that we own, you try to really focus on delivering that convenience, delivering that experience, and also in these regional neighborhood centers, it's actually an attractive cost for your tenants as well. So we are still believers in cities. You're starting to see a rebound in leasing and on the apartment side in New York, for example. But that doesn't mean that we don't still have enthusiasm for some of these suburban markets as well.
So Mark, where are you on that? I know you escaped New York to the burbs of DC. Are the cities dead?
Gee, I don't think so at all. I think, I think this is a time, I'm extremely optimistic. I think this is a time when whether you're a retailer or a healthcare provider or a real estate owner, if you're not laden in debt and you can be adaptable, I think it's a very optimistic time. I think that what happened, with the misery of COVID, is that people have adapted. So now a retailer has so many more outlets than they had before, and the same thing with a healthcare provider, as I described before. So I think it makes it a lot easier now to live in the city, because there's so many more services that used to be difficult for you in the city, which I think are going to be a lot better. At the same time, because I'm sure there's going to be some degree of hybrid work, you can be in the suburbs, on some days of the week, and be in the city other days of the week. So I think that, again, the people I fear for, people who went into all this with a lot of debt and aren't able to adapt. But I think anybody who can adapt in the service providing world, it's just vastly better. I live in an apartment building, and you see deliveries at the door, or you can go to a restaurant and pick it up. I mean, there's so many things that I think are going to be permanent advantages that make me, frankly, bullish on real estate. I wish I had a few $1 trillion like Ken has to invest.
I think it's 2 trillion.
Robin, I agree with that. I think that as so much has changed even in the last 12 months, right? In terms of the initial sort of shock and disruption from COVID, and then the adaptation and the flexibility and the innovation that we saw from our retailers, even those that are close to home, but that were forced to shut down and to adapt. And I do believe, whether it's the companies, whether it's the retailers, whether it's the restaurants, the strong operators, the strong companies that were not laden with debt, because you may have some that were laden with debt, but so strong and holistically with balance sheet as well as operators really did adapt, and they're going to be stronger as a result of that. So they're not just going to survive, they will thrive in the new environment. And we are already seeing that, right? We're already seeing increased demand even in geographies that are still more restricted, like California and New York. We're already seeing increased demand in those categories that were also more restricted because they've been able to adapt and are ready to compete in the new world.
And it is an exciting time for those companies that are going to adapt to the change, right? And that are looking forward as part of those changes. And by the way, I'd also say it's not the same for all different businesses, right? I mean, on the retailers, you have the examples of the retailers that have adapted to the buy online, pick up in store, and have really embraced the change and adapt to their business models. And the work from home, whether it's going to be some hybrid, that'll also vary by company and by sector you're in. Again, life science office is one of the big areas that we've been investing in the past 5 years, and that is a sector where you can't really work from home. Right. And you have to be in your lab space, and those office buildings stayed open. And those office buildings, Cambridge, Massachusetts is our biggest market, but also, San Francisco, San Diego, Seattle, Cambridge, UK. These markets continue to be really strong, and these tenants, need to be there and want to be there. And that's where the ecosystem is for their businesses, right? That's where the universities tend to be, the institutes, the private companies, the VC capital, and then the employees, right? And so you've seen continued strength in that sector, in those markets, and I think you'll continue to see these hubs and these talent pools and these knowledge centers continue. And yes, you will see change in maybe how people work in certain, whether it's a hybrid environment or not. But we're still believers in these ecosystems and these talent pools and being in these greater innovation and hubs and knowledge centers.
Plus, the world is, everybody in this world now knows the power of bioscience. So people who thought, yeah, in 100 years, maybe it'll cure something. Now they realize, oh my God, this is life-saving stuff today. So I think it just reinforces the opportunity.
Yeah, for that sector in particular. I mean, we had great enthusiasm for that pre-COVID, and you were looking at all the innovation and really exciting discoveries that were happening. And then COVID just shined a spotlight on the importance and innovation happening in this space. And over 40% of our tenants had been working on or have been working on some type of COVID-related, diagnostic or therapeutic or vaccine. So, and again, the building stayed open and really important and really exciting area to be in and to be a part of.
40% of your life science tenants have been working on COVID in one way or another?
Some way or another, yeah, more than.
Interesting.
But there's lots of other things going on, obviously, also in terms of innovation, and it's traditional office is this question of work from home and the purpose of office, and are we going to be partly, or some companies saying fully remote or back. Here you can't do your lab work, in your living room. You need that controlled environment. You need, the air handling and the power and the gas lines and waste lines and all that. So, it also depends on the business and the change that we may see in terms of work environment and where people want to live and things like that.
Yeah. So each of you has touched on the importance of technology in the properties. How do you think about how you access that technology? And let me throw this out to everybody, are you investing in prop tech companies? Are you getting consultants to help you with that? Are you buying prop tech companies outright? How do you think about that?
I feel like I should go first because Ken will trump me no matter what I say.
It's that $2 trillion.
Yeah, yes.
Oh, that's so handy.
I mean,
the record is not $2 trillion.
Again, this is not new. So it is something that we have been thinking about. We have been investing in Regency's way. We have considered prop tech companies and prop tech investments. We've never actually taken the plunge. We do have a director of strategy and innovation that runs the processes here at Regency. We just in the past 6 to 9 months, I think it is, we did bring in a strategic consultant that had that does not, I don't think they ever have before worked with real estate companies, but more consumer products companies, so that we can push our thinking as to how we think about genius systems and artificial intelligence and how will that impact real estate, as well as all of the other large, trends that are happening just macro in the world. And so then there is sort of the individual, like we are experimenting with drones, and how can we use drones to perhaps become more efficient in property management so that we don't have to visit the centers? Can we do virtual leasing showings? So we are definitely using all of those tools, but it's a process, and it's R&D, and there's no silver bullets for that last mile retail real estate as to how to use technology to drive bottom line results for us. Yeah, I think that will come, and it will evolve.
What are you doing with drones at this point?
Again, it is an experimentation, and while we have a great portfolio, mostly concentrated in major markets. There are perhaps some centers that we may have one or two in smaller markets. You can use drones to visit your centers and ensure that things are operating and are being maintained as well as they can be.
Very cool. Mark?
Well, for me, now I run a service provider, so I'm a tenant. So so I would say, if we're a good tenant, then we're investing in ourselves in making us much more efficient. And then we're working on something in urgent care where we're going to be both a tenant and a real estate owner. And there again, we're going to make sure that we're as technology enabled as we can be. That we'll do ourselves. So we're not over leveraged. So we are going to invest that way. So I think whether you're a tenant or a landlord, you ought to push this. But I think that now you'll get a return on it a lot faster than you would have in the past, because people's expectation or ability to adapt to using that technology is so much more immediate than it was a year ago, and I think that's a permanent advantage. The negative, I guess, is if you're in logistics or you think about the last mile, is people's expectations now are, forget Amazon now, it's like the Amazon yesterday. So I think people just, they expect immediate results. So keeping up with that expectation is a little bit difficult.
So Ken, why don't we close with you? We're almost out of time. Are you buying prop tech companies? Have you got a SPAC to go and merge with all of them? How's that all working?
We do not have a SPAC to invest in prop tech companies, but we made a handful of prop tech investments. But our primary focus with prop tech is, how can we, identify and use technology, to make us better owners and investors and managers of the property. I think similar to what Lisa is saying with her business. So we have a team of people within our real estate team across the firm. We spend a lot of time with our portfolio company management teams as well, identifying and evaluating different prop tech solutions for different properties across our portfolio. And we have, again, made a handful of investments, but more focused on using, identifying and using, whether it's, for physical improvements in our office buildings, touchless access control using your smartphone or smart home, a smartphone or smart home hardware or energy efficiency and utility tools to manage and improve energy efficiency. As Lisa said, on the leasing side, we did make an investment in VTS, View the Space, which was a leasing technology company. And also we've adopted or using a different company for some apartment leasing, doing virtual tours of apartments. So, whether it's the physical properties, the tenant or guest interactions, whether it's leasing or listings or virtual tours or the tenant or guest experience, at our properties, in Willis Tower, we have an app for our tenants. At the Cosmopolitan, which we own in Las Vegas, we have an AI chatbot called Rose that, our guests can interact with as almost like a virtual concierge. Tenant experience going back to the office and office scheduling. We've been working with different technologies for that. Of course, analytics and data management and transaction management tools, whether it's foot traffic, other things like that. So there are lots of different areas and prop tech is so huge, right, in terms of what technology can encompass. And we've really been trying to, at Blackstone, be organized in the different components of where we could, adopt technologies and sometimes invest. But again, it's really with a focus on using technologies to, be better investors, owners, and operators of our properties. And it's really exciting because there are so many ways to reduce those pain points, right? With the leasing process or tenant experiences and making your property more attractive. But there are a lot of different technologies. So identifying, the one to use, I think Lisa's one said they're piloting, right? I mean, there are just so many different ones to pilot, and then, having a process to identify, pilot, and then, use certain technologies. And it's exciting because it definitely, enhances, your tenant experience and your offering and your ability to manage your properties better.
Well, sadly, we're out of time, but this has been fascinating. I'm looking forward to getting on a plane soon and going to visit Rose in Las Vegas. I haven't met her yet.
Yes, exactly. But it's great, and it's better than you phone the concierge, you wait till I mean, it's another way to enhance the experience. And for tenants as well. And the leasing experience, has a lot of room for improvement from the way it's been done traditionally. And if you can reduce that friction and those pain points, I mean, that's just great.
Well, great. Well, thank you all. Really appreciate doing this. Thank you all for joining us. Mark GANZI, why don't we start with you and talk a little bit about what you're doing at Colony. So from what I can tell, you're repositioning the whole company, getting out of traditional assets, moving into digital real estate and what you're calling digital infrastructure. You want to talk us through the strategy a little bit, and also on the execution side, you're shifting the course of a large ship. How do you do something like that so fast?
Well, the idea was we became partners with Colony back in 2017 when we did a joint venture, which was to go out and raise the first of its kind digital infrastructure real estate fund. And on the heels of that, Robin, we very quickly in about 6 months raised $4 billion of institutional capital, which was pretty surprising at that time. And we had targeted raising $3 billion, and we'd hit our hard cap really fast. And so Tom Barrack and I looked at each other and said, wow, that was a little bit too easy. And then the hard part was, how do you deploy it? And so 2 years into that journey in 2019, we very successfully assembled 10 best-in-class portfolio companies in the digital infrastructure space, deploying not only the $4 billion of equity, but we also had raised $8 billion in co-investment capital, and we managed to go on about a $22 billion buying spree in terms of that particular fund. So we grew our digital AUM from roughly about $6 billion to roughly about, very quickly, $28 billion in a period of 3 years. And so we began to see this pattern that digital infrastructure and digital real estate, Robin, was growing at an incredible pace. And I'll come back to that in 1 second. So Tom had asked me to come out and sit with the Colony board in Los Angeles in the first quarter of 2019. And the board of directors said, we love what we're doing with digital real estate, and we'd like to make a strategic decision to focus all of our energy and pivot Colony as a digital REIT. And do you think that's possible, Mark? Could you do that? And I looked at them and I said, well, I'm pretty certain I can raise more capital, and I'm pretty certain I can build more great digital companies. I just don't know much about limited service hotels and healthcare assets, but I'll give it a try. And so we merged our companies in July of 2019. The board asked me to become the CEO at the beginning of 2021. And off we went on this journey together, Tom Barrack and I, to transform Colony. Literally, I was there for about 6 months. And, what we began to see is that we could sell assets. And so in 2019, we sold our industrial portfolio. We started selling other business units. We got out of multifamily in our partnership with Rosen, Mark PARRELL, Courtland quite well. And we began to sell assets at a very good cadence. And as 2020 came around and hit, the board was very happy with the rotation. They asked me to move into the CEO chair last year. So I did. And then it really was about shoring up the balance sheet. I knew that I had to delever company from 12 times to 7 times. So we made a series of constructive moves to delever the company. And I got leverage below 7 times. And then I had to fix the cost structure. We were running at about 320 million of G&A, and I was able to successfully remove about 110 million of G&A and about 150 people globally and remove 11 offices. So for me, it was delever the business, sell core real estate, take down the G&A, raise more capital, deploy more capital in digital, and take a business that was 48 billion in traditional real estate AUM 3 years ago to today we're at 30 billion of digital assets. We have about 17 billion of traditional real estate left to sell. We actually are literally, as we have this conversation, we're selling our hotels. Those hotels have finally moved to Highgate and Cerberus. We made an announcement a couple weeks ago to internalize our mortgage REIT. So we've sold the management contract. We're getting out of the mortgage REIT business. And then all that'll be left is really our 400 medical properties and the traditional private equity and real estate business, which we've announced another 440 million to $600 million of dispositions. So it's been a wild ride, I will tell you, in the almost 2 years that I've been here, but it's been a lot of fun. It's had its host of challenges, but we're really taking Colony Capital to the place where we think will be very good for shareholders and most importantly, good for our tenants and ultimately, build a next generation digital REIT.
And Mark, when you say digital assets, walk us through what's the breakdown? What are these things, and what's the attraction relative to traditional assets? Is it better returns, better growth prospects? What's the idea?
Well, look, I think we think of digital infrastructure or digital real estate in 4 distinct buckets, Robin. One is towers, which has been a REIT asset class since the early 2000s. Data centers, of course, which has been very successful. Digital Realty, Equinix, CoreSite, CyrusOne. Fiber is now REIT. Unity has proven that it can be a fiber REIT, that you can put underground conduit into a long-term REIT structure and get the PLR, get your private letter ruling and have your TRS. And so I think Unity is a great blueprint. There's going to be other fiber businesses that will come to market. And so that's exciting. And then the last vertical is small cell and Wi-Fi infrastructure. So those are those small antennas that are on places in difficult to build areas like San Francisco and Malibu and other places where you can't build towers. Or for example, we own a lot of the infrastructure in stadiums across the United States. And we just did a deal in the UK with all the English Premier League stadiums. And so we put in those fiber, those antennas. So when you go to a basketball game or football game and your phone works, were the days when we used to be able to go to basketball games and football games, but we own that passive and active infrastructure and we help make that work.
Well, sounds exciting. Not sure whose dog that is, but he sounds he sounds excited to be sure. John, Kilroy, let's shift to you, and then Mark, we'll come back to some of those and talk maybe about the interplay of those with the traditional assets. But John, from your perspective, this panel is really about reimagining real estate. You've really become the office landlord to the innovation class, the high-tech companies, the life science companies like that picture behind you. Does that mean you've effectively already reimagined the office? And if so, what's the lesson for the rest of the office market and the rest of us?
Yeah, those are great questions. And yeah, we get a pretty decent perspective from what's going on with the tech community. I think we're probably the largest provider of space in the United States to the tech community. And of course, now life science, the media communities and so forth. And, Robin, and anybody else that's listening, the average age of our portfolio is about 10 years. So we saw this coming for a long time and really repositioned the company to have what we think is the modern transformative real estate. And it's no surprise. This came about pre-COVID. People are trying to attract and retain the best and the brightest. And so they want business communities or apartment communities nearby that provide the kinds of things their people want. So we do continue to reimagine because we're getting input all the time. And in fact, I was with somebody that's the CEO of one of the major tech companies the other day, and they were asking us, would we go elsewhere other than the West Coast because they can't get the same level of attention and thoughtfulness in some of the places they're at. You know, this whole digital thing that has been going on for so long, of course, has been accelerated by COVID. And I don't want to speak as a residential expert because we only have 1,200 units, so, but they're all pretty new. The thing that we're seeing people, whether they're in an apartment community, whether in an office community, a life science community, is the no-touch leasing experience is common throughout. The adaptation of virtual services throughout all of our enterprise has accelerated. One of the things we're spending a lot of time doing is looking at Gen Z and the way those folks are going to think about both their living experience as well as their office or their life science experience. Mark, PARRELL, I'd love to get to you and some of the others in your area and compare notes. But we're seeing technology now go way beyond where it's been. And I think COVID has accelerated that. In the construction side of things, we live in a digital world amongst the architects and amongst the contractors. What we see though, which is not compatible, is the planning departments, the cities, the states, and so forth are still stuck in an analog world. And so what we're seeing is the efficiencies that we as an industry can bring forth are not being mirrored by the very people who regulate us. And surprise, surprise, I've never been a fan of government. I continue not to be a great fan of government. But these things are all forces that we're working with on a daily basis. And I think it's amazing. You know, we go into an office building now, or you go into one, you don't have to open the door. You don't have to open the door to the restroom. It's a kick thing. Of course, we've seen faucets and toilets and all that sort of stuff be digitized and hands-free for a long time. I think we'll get to the point where you just think about something and it'll happen. I mean, it's actually transforming that quickly. When you have when you move into an office space or you move into a conference room, it records how many people are there. It determines how the ionization works for airflow and air purification. It alerts people when you're out of the office or out of the conference room when they need to come in and clean up. So we've been a leader, but by no means are we taking this as something that's static. It is changing daily.
So what is it about the office buildings that you build and run that makes them that much more attractive than the average stock? It can't just be that you don't have to touch the elevator button, or that there's an ionization count.
Well, those are a lot of those things were happening beforehand and accelerated by COVID. But the modern office building is far different. We used to think office buildings, the best ones were the tallest. And really, if you think about a lot of the tall buildings, they were manifestations of the executive or the CEO. They wanted to have the tallest building, you know, the most importance or whatever. Today, we live in a world where it's much more egalitarian. It's much more geared towards the worker. And so big floor plates, and by big floor plates, I'm not talking about 25 or 35,000 square feet, but we're actually doing floor plates that are articulated so they don't look so big when you're inside, but they're up to 100,000 square feet and 15, 16, 18 foot clear rather than the previous 8 or 9 or 10 feet. A lot of penetrations, a lot of open areas outside, decks, terraces, rooftop decks, areas that companies can control, but their most important resource their people can use and have much more of a sort of a live work experience while at the office. We don't even call it office anymore internally, but it's far more dynamic than it's been in the past. And if you are in the traditional, and we have some of these traditional sort of 30-story buildings or taller that don't have those features, I think you have a dinosaur.
So speaking of, you don't call it office anymore, the picture behind you, tell us about that project. That looks very cool.
What's behind me is a 50-acre development we have underway. We're about ready to start the second phase. It's a total of 3 million square feet. It's life science. Although one of the first tenants was Stripe when they moved out of the city of San Francisco, they relocated their headquarters, or they will be relocating their headquarters there. And this is one of the hottest markets. Life science in San Francisco is San Francisco area is geared towards South San Francisco. It's much like Cambridge. I think they're neck and neck in terms of the amount of square footage and the types of companies. It's one of the two biggest clusters. Has a vacancy rate of about 1%. Rents have moved up about 25% since we bought the property a few years ago. I think it'll move up another 25% over the next couple of years. And the demand is just off the charts. And the thing that we're seeing, whether it's in San Diego or where we do a lot of life science and office, or here in the Bay Area, is there's this incredible collision going on between tech and life science. Tech wants the same space, or life science does now, that tech has, and they're both after big clusters. So we have this new dynamic, which is life science, who traditionally took a long time to make a facility decision. Think about it, they're geared towards FDA approvals and all these government regulations and so forth. And then big tech, who makes decisions in a nanosecond. And all of a sudden, when they're competing for the same space, life science now has to make decisions much more quickly. And we're building facilities that basically appeal to both, and we're getting competition from both. So decision-making is accelerating in life science, and rents are accelerating in those communities. So it's kind of a virtuous cycle, particularly for a landlord.
Sounds like a nice spot to be in. Mark Parrell, on the multifamily side, probably also a nice spot to be in, because am I correct in thinking that even in an Amazon world, people need to live somewhere? So your business doesn't need as much reimagining as others. Is that fair, or is there more to it?
You know, we don't see the business as having as much risk or extreme disruption as some other businesses, but especially some of the other major food groups in the property space. But there are things that are changing, pretty significantly changing. I mean, John spoke about the technology. I mean, our customers are people that work often in the technology, biotech, legal, medical fields, and they're used to using technology. They want a touchless virtual leasing experience. They want to pay remotely. They want to communicate with us in a manner in which they're accustomed, which might mean text messaging and doing a lot of other things that even 5 years ago we weren't able to do. And now we can do all those things. So I think that the disruption in our area has been a little bit more operational, but there's also this disruption about where people are living. And I think we're focused on this affluent renter. And for us, that was 6 markets, Boston, New York, DC, San Francisco Bay Area, Southern California, and Seattle. And that person, even before COVID, that started to disperse for us. We started to see this well-earning, long-term renter move to places like Austin and Denver, and we started to move. We started to allocate capital to Denver. We're working on some other markets. So that sort of disruption, or that sort of gradual change, that word gradual got left out. And I think in COVID, people just moved a little more quickly. So I think we're seeing much more dispersion in these high-wage jobs, a lot of demand for technology in terms of how we take care of our resident and our prospect. And I think that's just going to accelerate.
And the reason they're moving is because they can Zoom to work back in New York, or it's
it's not as much the remote office thing we can talk about just for a second. But I think, cities have different amenities. And, your hometown, New York, has, of course, the Lincoln Center and Brooklyn, and people live there for certain experiences as well as because their employers there. Now, I was in Denver. It was my first business trip in months a few weeks ago, because we're really focused on buying there. And that experience is really about being outside. These dense, closer in suburbs and the area city of Denver, people are okay with going into the city. There's some restaurants, but it isn't nearly as significant an amenity as the outdoors. People there have a car. They want to get to the mountains. They want to recreate. People want to get out on the bike trail that's right outside their front door. So I just think that millennials, and we think likely Gen Z, is just going to have a little wider aperture in terms of places they think are good places to live. Then we've got to sift that, because just because they want to live there doesn't mean we want to rent there. Because some of these markets are really cheap to buy a home. And that makes them less good apartment markets long-term. So from our perspective, Denver, where home prices have really gone up a lot, Austin, those start to be more interesting and compelling apartment investment opportunities too.
Interesting. So let me ask all of you the next question, and maybe Mark GANZI, we'll start with you. We're emerging from COVID. Digitalization has accelerated. Mark, you're obviously making a huge bet that's where you want to invest. How do you see, and then I'll ask each of you, what's the new normal going to look like, say, a year from now, when everyone's vaccinated, et cetera? How much of what we've seen the last year is going to continue? Do we just go back to where we were 2 years ago, or is it a totally different world?
Well, I would say, there's things that'll come back to normal, and there's things that I think will be redefined as the new normal. I don't think we go back exactly to where we were per se. I think certain sectors we see significant disruption, and it's going to take a long time for hospitality to come back. It'll take a long time for the airline industry to ramp back to capacity. The cruise ship industry is going to take a long time to come back. And then we see pockets, as Mark Paarrell said, experiences are what people want. So, during COVID, people did find some experiences. They found different experiences. And I think some of those experiences will stick and some go away. I think we've tried to reimagine our workforce a little bit. A lot of our workforce has shifted to South Florida, out of California. We've got new work environments in Singapore and London that are thriving and are growing quite fast. And we've also accepted, as we've expanded our headquarters and reimagined our office space, similar to what John Kilroy was saying, our new office space looks totally different. We have very few private offices. We have a lot of common space, a lot of places where people can park for a day or 2 days. Very few people will have permanency in our architecture for office space going forward. It'll be a lot of, visitation offices. It'll be a lot of common spaces, a lot of what we call think tank rooms. And I think that's just kind of going to be the new norm. Some of our employees will platoon in. Some folks will work from home a couple of days a week. We don't mind that. We actually saw our productivity rise during COVID. It didn't fall away. So clearly we were doing some things that were enabling more productivity. And then I think as we think about this notion, Mark Paarrell, about home versus, what happens at home, what happens at work, will people be able to work from home? The digital workloads that were happening in our residences, whether it's rented or owned, was unprecedented. So for the work that we do, we've seen a shift in technology, and we've seen a massive shift in digital infrastructure, digital real estate being pushed, Mark, to the perimeter. And so you follow the traffic, right? And so as we think about what happened in COVID, where we're doing most of our e-commerce from home, we're doing home fitness. I did a bunch of telemedicine during COVID. We take calls from home. Our kids are educated from home. So this put enormous pressure on the infrastructure, not in the core of big cities, but really, Robin, in the suburbs and in secondary and tertiary markets. That's where we saw the most growth. And so this new notion of edge computing, which you hear a lot of that being misused today, it's really where the edge of the network is, and where there's failure for Amazon, or where there's failure for Slack or Zoom or Peloton. And so we've had to work with our customers to bring more capacity, more applications, more fiber, more towers, and more infrastructure to the edge. And so that's created a huge amount of pent-up demand for what we do. And I don't think that goes away. I think ultimately the use patterns that happened in COVID only accelerated what was supposed to be coming 5 years from now. So as we think about things like 5G and edge computing, you think about IoT networks, autonomous drones, autonomous vehicles, all this stuff has just been pushed along a little bit faster. And so we're going to see an acceleration in digital real estate and digital real estate CapEx spend. There's about $378 billion of total digital real estate spend last year. That number is going to $400 billion this year, and it goes to $425 billion next year. So just think in just this short window of time, $1.2 trillion of digital CapEx is being spent. It's a staggering number to keep all of this digital economy moving. So we're pretty bullish about being in the digital real estate business. And some of this goes back to normal, some of it doesn't, but I think we as CEOs define the new normal for our companies and our culture.
John, if everything Mark just said is right, maybe it doesn't affect demand for your office product because you're renting to the people who are creating all of this. But thinking across the nation, isn't that going to translate into much less demand for office?
Well, I agree with much of what Mark is saying, and the numbers are clearly that. And as we look at the workforces, what we're seeing with major employers on our platform is that they are embracing both. And so basically, if you think about certain kinds of engineers, there are two companies that have made recent announcement that they're hiring between 10 and 20,000 engineers in the Bay Area. And when you ask why are they hiring the engineers in the Bay Area, it's because that's where they live. That's where they are. So there's clusters of different kinds of expertise. Some of it's very transportable to wherever you want to live. Some of it is not. I don't think office space goes away, but it definitely is going to be used differently. And Mark, I'd be interesting, GANZI, to hear what your office configuration is. I just toured a building that we're doing that's about 750,000 square feet for one of the biggest tech companies. And what they started out with is roughly 80% workstation and 20% common area. It's now 50% common area. So fewer employees, a lot more. We're blurring the lines between the traditional office, residential, sort of a retail, almost a hospitality look. It's very much about where you can get people to be comfortable and collaborate in different kind of workspaces. They're not desks always. This innovation center that I'm in has, I think 8,000 square feet. I think we have 2 desks. We have different seating clusters and presentation areas. And this is far more representative of what we're seeing in amongst our office using community. Now, life science is totally different because you're dealing with labs and all that sort of stuff. So, they can't have quite that freedom. And what we're hearing and seeing is that the square footage per person that had traditionally been, back when I was a kid starting out, it was sort of 350 feet or 400 feet per person. And then we saw it get a couple of years ago down to 105 feet per person. So 9 people per 1,000 square feet from 2.5 people. It's going much more back to the 2.5 people per 1,000 square feet. But getting people together to collaborate. What we found and what we're hearing from our client base is they're having a difficult time with collaboration online. So it's just not the same, okay? Humans want to be together. And I think all of our businesses are, what Mark GANZI is talking about, it's absolutely true. We all rely upon the devices we're looking at one another on, and these things, probably far too much, but it's undeniable. And you got to have the infrastructure to run this stuff, whether you're in the office or whether you're on the chairlift. I called a guy the other day. He's the head of real estate globally for one of the biggest tech companies. And I caught him on a chairlift. And we continued the conversation. Finally, he said his hands were getting cold. So he went inside to the place he's staying. And all of a sudden he was in a digital kind of living room in an apartment building, or rather a residential building that had been reconfigured over the last year. And that's the world we live in. Yeah. It requires infrastructure and it requires places that people can communicate and collaborate. And it's morphing daily. I think it's really exciting.
You should tell that guy to get a headset. Mark,
I was envious of his skiing. He was skiing, I was in an office.
Mark PARRELL, so translating all of this to the apartment building you'll build in 10 years, is that going to be a combination office apartment building with lots of common areas where the tenants can work instead of bothering to go into John's buildings? Or what's your take on that and everything else you've just heard? We're going to give you the final word.
Wow. I think both Mark and John had a lot of good, exciting things to say a moment ago. So I don't know how well I'm going to do at cleanup batting, but we look at the apartment building of the future, and we do think that people are still going to go to the office. We are not thinking in our minds that the office is in any regard dead. I mean, what we see and feel in our own workforce is a loss again of collaboration, an increase in loneliness. There's a lot of survey work that's been done. People love not commuting. They hate not seeing other people. There's a certain set of people, probably programmers, engineers, quiet people that work on tasks that are just their own, that probably benefit from not coming to the office at all or very much. But that isn't the majority of, I think, a dynamic workforce. And I for one, feel a decline in the energy in my company and a loss of some of that collaboration. And I don't know how you onboard people when you don't have them in person. I don't know how you impute your culture and you get people rolling. So our perspective is our apartment buildings will have more common areas with more single seating. 2-3 years ago, we were doing the bench seating sort of format where you're sitting almost at a picnic table. And now it's these higher end buildings. These are more nooks. But the biggest challenge we think is all the stuff going on around environmental and sustainability. I mean, the built environment is a huge source of emissions and carbon. And we're getting a lot of pressure as an aggregate, both in the office space and certainly in apartments to do a better job. A lot of cities are putting out rules. And it's interesting, you can think about the digital and virtual environment, and it can do wonderful things. It can manage energy usage by managing thermostats throughout your buildings. But we own a lot of 40-year-old apartment buildings that are just fine. They're not obsolete, at least they weren't. And they use a lot of power. They're not particularly energy efficient. And so there's going to need to be some really awesome engineering in the next number of years to take the built environment to the next level. Whether, and there's things we've been talking about ourselves, tankless hot water heaters, windows that are either much more efficient or even solar, more insulation. I mean, the built environment needs to adjust. The new buildings we're building, we built one in San Francisco, and they're LEED Platinum and LEED Gold, and they're done both not as much as John would build for his tenants, because honestly, our tenants aren't asking for this yet. We're doing it because we expect our institutional buyer 10 or 15 years from now will require it. We're doing it more for the buyer. Our residents won't pay more for a building that's LEED anything. There just isn't. We've done the survey work, and there's very, very small constituency for that. So I guess what I'd say is I think you're going to see more nooks and more flexible space in apartment buildings to do a work from home thing. But if you went to one of our buildings even before the pandemic at 2:00 on a Tuesday, there were a number of people still already taking advantage of the digital network that MARC is creating to work remote a day or two, or they were freelancers, and then they went to the office the other 3 or 4. I think our space is ideally designed with that flexibility in mind. I think our common areas need to be a little bit more individualized and less common, frankly. I think a little bit more individualized. And I think we really need to figure out how to make our buildings much more energy efficient. And that's going to be a huge engineering challenge. It's not, to me, mostly about software. It's mostly about hardware and engineering.
So Mark GANZI, that's where your companies.
It's worth saying because we're spending a lot of time on this in the resi market, Mark, and we're spending a lot of time in the office building segment, John, around what we call enterprise 5G. So there was a whole new band of spectrum that was just auctioned off, Robin, called the C-band. And its application is not about us talking on the phone or us sending, TikToks or whatever. It's really about device to device connectivity. And so this notion of producing the enterprise at a higher level revolves around us interfacing with the elevators, the HVAC system, security systems in the buildings, and all of this is becoming smart in the respects that AI is helping the algorithms develop pattern recognition and ultimately help the buildings get smarter in terms of where you turn up energy, turn down energy, patterns for how cabs run in terms of if there are elevators and some of the stuff that John's building and what you're building, Mark. And all of these things run on something called IoT devices. And IoT devices require data centers, fiber, and towers, and small cells, and other types of network infrastructure. There's 8 billion devices on this planet today. 8B, that's with a B, 8 billion IoT devices helping run our lives today. That number goes to 20 billion in 3 years. it goes to 500 billion in 8.5 years. So think about all of the sensors and all of the things that are required to create a smart apartment, to create a smart office building, but that's not reflected in our cap rates. It's the same with us, Mark, PARRELL. We built the first LEED Gold data center in Santa Clara. We built this massive campus for an unnamed cloud player. I'm not allowed to say who it was. And it was the first of its kind geo-cooled data center where we use San Francisco, we use the Bay's area temperature to cool it. And only 60 days a year, John Kilroy, are we operating on a synthetic cooling system. And that data center consumes like 80% less power than any other data center we have, because cooling is the #1 thing that we have to pay for. And I guarantee you, Mark, we won't get any recognition in our cap rate for having the best LEED Gold standard data center in the world. All they care about is the investment grade tenant who signed a 15-year lease in there. That's really what Moody's and Fitch looks at. They don't give us an ESG score. I had this conversation with the head of esoterics at Fitch last week, and I said, look, if I go to 100% carbon neutral in my edge data centers, because we did a securitization last week in one of our data center business, will you give me a better rack? And they looked at me, they're like, why would we give you a better rack? It's costing you more money to basically go net zero. And I was scratching my head. And look, pension funds and insurance companies around the world and sovereign wealth funds, they care about ESG. They care about us investing carefully, and they care about us creating, digital spaces that are going to have a positive impact on the environment. But there still is a gap between doing the right thing and ultimately the reward we get for returns. And there's an inefficiency there that hasn't been quite priced out yet. And that's something I think probably if we came back in a year, Mark and John, we'd be talking about it again. Mm-hmm. What do we get as CEOs? What do we get as people that take risk in property for doing the right thing, for going net zero, for going, the extra mile in ESG? What are we going to get out of it other than social impact today? And I think that's a debate we're going to carry forward.
Mark, I've begun to see this tangibly, not only in the investor community, people who buy our stock, and the Europeans were way ahead on this. But what we're seeing it right now, we just announced a big deal. We're selling a building that we built for, $600 million. We're selling it for $1.1 billion. It's one of the better buildings here in the city of San Francisco. And the pool of buyers that were looking at that were all major institutional buyers, some sovereigns, some domestic. And the thing that we've seen amongst the pool of buyers for assets is they're recognizing that there's been a fundamental shift in what constitutes a long-term quality investment in a building versus the old style buildings. And I think that's really positive. And we achieved the highest price per square foot on that building that anybody's achieved in San Francisco. And a lot of that was just directly related to the fact that this is a new age building that's going to perform well over a long period of time. So it is, you're right, it lags, but it is happening.
Yeah.
Hey guys, I'm getting frantic texts. We're over time. This has been really fascinating, and we probably should do this again in a year and see how wrong we were or right we were about stuff.